What's up, guys? Welcome back to the YouTube channel. I'm going to be sharing with you guys counter trend trading ideas. So there's three different counter trend trading models that I'll be sharing in this video, which you can use to trade against the high time frame trend when all the confirmations are there. I'll also be sharing with you guys the callouts I gave opposing to the trend. So, none of this is in hindsight, and I apply these models every week when I trade live. So the first of the three models is TGIF, the end of a weekly candle. Now, use this logic and you can also apply this to a monthly chart and a monthly candle. But for this example, we're going to go over a weekly candle and how I call the TGIF play here using all of this. Okay, so the criteria we want to meet when we anticipate a retracement on Friday, opposing to the trend we had throughout the week. The first thing is the weekly objective or a higher time frame key level has been met. TGIF is a 20 to 30% retracement of the weekly range up until Friday. So the range we've made from Monday until Thursday, we're looking for a 20 to 30% retracement of that range. Previous day high or low must be taken, and watch for SMT between Thursday's high and Friday's candle. We must be in a premium or discount depending on if you're bullish or bearish of a H4 and or H1 dealing range. Asia and London do not retrace to discount if bearish TGIF and premium if bullish TGIF, or does not retrace the 20 or 30% of the weekly range. If bearish, we must be above the opening price at midnight. If bullish, we must be below the opening price at midnight. There must be obvious lower time frame liquidity, such as relative equal lows or highs. And I use TGIF in New York kill zone. I don't really trade it in London. So that's what I'll be sharing here with you guys. So here's a diagram of TGIF. So if this is a weekly candle here, and this is Monday, Tuesday, Wednesday, Thursday, Friday, what we're trying to do is understand the open, high, low, close dynamics here. So we have an open, low, high, and close. So every candle has this. And on a weekly candle, understanding this can give you an entire day's daily bias, such as Friday here, right? So just catching this wick here of the open, low, high, close is an entire day daily's bias here. So bullish example here. We had Monday, Tuesday, Wednesday, Thursday trading lower. A higher time frame objective is here that we've met, and then we see a TGIF on Friday here. Okay, we're going to be going over this example of this weekly candle. So very recent price action just last week, right here. So we're focusing on the high and close, right? So this is a bullish candle, right? So we're counter trend trading this, and we're just looking for that high to the close, right? And we don't need to predict the closing price. All we're looking for is a run on Thursday's high with SMT, and for us to meet the previous checklist that I mentioned. Okay, so on a daily chart here, you can see this week we had a drawn liquidity above these highs, and on Wednesday, Thursday, we can see we traded to the buy side liquidity above this swing high. And then the weekly objective, when you're in all-time highs, you want to look at round figures as objective. And we met a 23,300 round figure weekly objective. And you can see this is Friday. So we had Monday, Tuesday, Wednesday, Thursday, and then you can see Friday is a bearish candle here. So this is the counter trend play we're looking at here for this first example. Okay, here is the call out from the Discord. So you guys know none of this is in hindsight. This was London's high run on Friday, right? And we were looking for a counter trend trade down to relative equal lows, like I mentioned in the checklist, obvious liquidity, and a fair value gap here. Okay, and this is what ended up happening. Okay, so just reminding you here, we've run the previous day's high here, Thursday's high taken into 23,300 round figure, which is the weekly objective on a Friday. Now, what was another one of the checklist criteria? We need to be in a premium, if bearish, of a H1 and or H4 dealing range. So in this case here, we have this H1 dealing range from this low to this high. We can see at the time of TGIF in the New York session, we are in a premium. So we've checked that off the list and we're above the previous day's high. Another one of the points we have to check off is, are we above or do we go above the midnight opening price on Friday TGIF during the New York session? Yes, we do here. So we've checked off another point on the checklist. Okay, now looking at this here, we can see the market's gone above the highs. We're above the previous day high and we're above the midnight open. all of this price action here is in a premium. So it makes sense for the market to trade back down to discount. And if we have all these targets above in a premium, it makes it high probability for the market to at least trade through some of these levels of liquidity. Now, do we have obvious liquidity? And this is something you have to answer for every trade you take, right? This is not just for TGIF. If there is no obvious liquidity, I don't take a trade. So in this case here, you can see the relative equal lows that we engineered as we traded up above this high here on a day that makes sense to be bearish because we're focusing on the open low high close of the weekly candle. The market then engineers these lows, and it makes it very easy for us to anticipate that the market will run out the sell side liquidity here. And then we also have the small relative equal lows here with these candles here, and then the open fair value gap that's still in a premium, right? So it makes it very high probability to see the market trade back here. And you can see we eventually get back down into discount before we chop up. Like I mentioned, you want to watch out for SMT. And in this case, we had SMT between Thursday and Friday's high here. So you can see NASDAQ makes a higher high, whereas YM makes a lower high. So we have another point checked off our checklist, which makes the trade higher probability. Now some lower time frame price action here. You can see we are within our New York session kill zone. 930 is right here, this candle here. And this is all post 930. We then have a break in market structure here after the SMT. And then we have the first presented fair value gap here, right? Post 9:32 a.m. We trade back up. We color outside the lines a little bit, displace lower. Then we have this huge wick here, which is with the 10 a.m. news. And all of this, notice, is above the opening price at midnight. Then market expands lower and we have a bearish order block. Then we see the market sell off to that 5-minute fair value gap, and the sell side was taken here before. Okay, lower time frame SMT as well here with this high right here with this wick candle from 10 a.m. orange folder news. Okay, model number 2 for the counter trend trading. 3 drives counter trend trading model. Once again, this is going to be on the higher time frame daily chart, as you'll see. The first thing we need is a daily unmitigated fair value gap above or below us. So if we're bullish and we want to take a bearish counter trend trade, we're going to see a bullish fair value gap that's open below us. We want to see external range liquidity taken. Okay, and if you guys aren't familiar with external and internal range liquidity, I have a video of that on my channel. We want to see 3 drives on the daily candle. Market must be in a premium or discount of H4 or H1 dealing range, depending on if you're bullish or bearish. We must be above the opening price if bearish and below if bullish. Once again, lower time frame liquidity must be glaringly obvious and an entry model within a kill zone. Okay, so a diagram of what this looks like, right? So we have external range liquidity here, okay, on a higher time frame chart. So this would be like daily, etc. We trade up into the external range liquidity, and then we see the market give 3 drives higher on a daily chart with closures within. So as we trade up into that external here, we can see the second candle takes the first candle's high, closes within. Then the third candle takes the second candle's high and closes within again. All of this while the unmitigated fair value gap is open. We can trade the 4th day down into the fair value gap. Okay. We're going to be looking at this example here. Okay, so this day shorting it back down into this fair value gap here. Okay, none of this is hindsight. Once again, at the morning, I wanted to see ES trade back down into the daily FVG here, right? And I mentioned if there's structure for shorts around 9:30 a.m., this is the bias we will go with. Not interested until New York session. Now, the reason for this call out is exactly what I'm going to show you here. Why was I bearish? I'm sharing exactly that with you guys here in this counter trend trading model. And you can see here was the New York AM session play. I wanted to see the buy side get run here and then sell off to the relative equal lows, which happened beautifully. Okay. So here it is, the external range liquidity on the daily chart. You can see we take that there. Okay. We have an open unmitigated fair value gap below us. Okay. For the day. and then we have 3 drives higher. So we take the external range liquidity. The first high gets taken here, we close within, and then we form this fair value gap here, okay? Still untapped. On the third day, when we run the second day's high, we close within again. When we have this here, we can short it down to the daily fair value gap. Okay, this is extremely high probability. I urge you guys to go back into your charts and look for this here counter trend to the bias, and you're going to see you can find some really easy counter trend trade ideas with this right here. Okay, here is a 4-hour chart. Okay, this is the 4th day, so this day here, and this is New York sessions candle. This was the 3rd drive where we closed within, so very easy shorts to the daily fair value gap here. Also notice, are we in premium of a H4 and or H1 dealing range at the time of New York here? Yes, we were in a premium. We also had this IFVG here, so we closed below this bullish fair value gap. We can inverse it for shorts. So this was a confirmation for me that the market was going to trade back down into the discount fair value gap here, as well as the daily candle closures above external range liquidity and the daily fair value gap staying open. So this was the key level that I went into the New York session with. And once again, that's what this call out here is. London sessions high gets run at New York 9:30 a.m. In that H4 IFVG, we are above the midnight opening price, and then we see the market sell off very aggressively on that 4th day back down to the daily fair value gap, completing the second counter trend trading model. Lower time frame here. Remember what I said to you guys, if there is no obvious liquidity, there is no trade. So as the market trades up above London sessions high here, we can see we're above the midnight open and the obvious liquidity with the relative equal lows here. Now the market trades up above, trades lower, right? If you couldn't find an entry here on a 1 minute, that's fine. We came back down here, engineered more equal lows here, 1, 2, 3. This makes this a high probability fair value gap, and keep in mind our drawn liquidity is all the way down here at the daily fair value gap. So we displace lower, trade back up higher, small little M1 fair value gap there, and then we displace hard down to our daily fair value gap drawn liquidity. So everything was checked off here, and we were within New York session kill zone. Okay, counter trend trading model number 3. This is going to be very similar to the second trading model, but slight variation here. Once again, we want to see a daily unmitigated fair value gap below or above us, same as the previous model. External range liquidity must be taken once again. However, in this case, a daily swing high or low must form. Okay, and I'll show you an example of that. In a premium or discount of a H4 and or H1 dealing range, if bearish, once again, we want to short above the opening price at midnight. If bullish, below the opening price at midnight. Lower time frame liquidity must be obvious, and we must have an entry model within a kill zone. Okay, so here's what this third counter trend trading model looks like. We have hard time frame external range liquidity here. We have an open fair value gap that hasn't been mitigated, and then we form a swing high. Okay, so the swing high must form when we're counter trend trading, right? That third candle has to close. And then if the fair value gap is unmitigated, we can trade the 4th day back down into the fair value gap after that swing high has formed. Bullish example here, external range liquidity taken, bearish fair value gap just above us, right? Open here. And then we form a swing low. So 4th day, we trade that up into the daily fair value gap, and that's our counter trend play, right? So in this case here, starting off the year on NASDAQ, we had an extremely bearish higher time frame market as we traded below external range liquidity here. We then see the market has a open fair value gap above us, and we form a swing low. Okay, so 1, 2, 3 candles forms the swing low after external range liquidity has been taken, and there is an open fair value gap above us. You can trade the 4th candle up to the daily fair value gap, and that's the counter trend play. Very mechanical, very easy to see on the chart, and it repeats. Okay, so I urge you guys to backtest this. This is the day after the swing low formed. Same as the other examples, we must be in a discount if we're bullish of a H4 and or H1 dealing range. So we're clearly in a discount here. Okay, Then we have the midnight opening price. We want to see price trade below that if we're bullish. Small little fair value gap on the hourly chart here. And then we see a large expansion to the daily fair value gap above us. Some PM session expansion here. So we have that lower time frame SMT, right? We obviously have the liquidity here and the liquidity with the relative equal highs here on the hourly chart. Then PM session opens at 1 p.m., 1:30 p.m. here. It trades back down into a breaker here and then expands all the way up until the daily fair value gap above us. Okay, I hope you guys enjoyed that video. Like, share, and subscribe, and all the links to my Discord group are in the description below.